Since 1979, income for the top 1% of US households has surged over 500%, while income for the bottom 20% has grown just 31%, a more than 16-fold difference over 4 decades. Welcome to the Commercial Pulse Update for March 13th, 2025. The Experian Commercial Pulse report is a biweekly report offering a snapshot of the US economy and its impact on small businesses. The economy contracted by 0.3% in Q1, according to the Bureau of Economic Analysis, and this is the first economic contraction since early 2022, driven by a surge in imports ahead of expected tariffs. Unemployment in April held steady at 4.2%, consistent with March. While job growth softened slightly, wages continued climbing, averaging $31.06 per hour, suggesting ongoing labor market tightness. Inflation eased to 2.4% in March, down from 2.8% in February. Core inflation is now at 2.8%, its lowest level since March 2021, and a sign that the economy is cooling but not stalling. And finally, consumer sentiment fell to 52.2 in April, a 32% drop from a year ago, reflecting growing public uncertainty, and it marks the 4th straight month decline and the lowest reading since mid-2022. The Experian Small Business Index rose to 47.2 in March, up 1.8 points from February's 45.4 reading, marking the 3rd consecutive month of growth. But the year-over-year remains down by 9.3 points. While optimism among small business owners is slightly waning, it's still above historical norms. New business formation is thriving, with over 452,000 new businesses launched in March alone, and that's a 6.4 jump from February. The sustained momentum suggests that small business owners are investing and pushing forward, even in the face of economic uncertainty and shifting consumer sentiment. And this week's Pulse report includes some fascinating data on an unfolding K-shaped recovery. What's a K-shaped recovery? In essence, some segments, particularly high-income households and businesses in affluent areas, are thriving, while others, particularly in low-income communities, continue to struggle. The long-term effects of a K-shaped recovery include extended unemployment for individuals in the lowest income quintile, increased wealth disparity, an ongoing and deepening racial wealth gap, and the rise of corporate monopolies. Here's what the data is showing. The top 10% of US households hold over 67% of national wealth, while the bottom 50% holds just 2.4%. Income growth since 1979 has soared over 500% for the top 1%, but only 31% for the bottom 20%. Since 1980, the bottom 25% of counties in the US, in terms of household income, experienced 56% growth in income. In contrast, the top 1% of counties saw an income increase more than 3 times higher at 172%. Retailers in affluent zip codes show better credit scores, lower delinquency rates, and faster recovery trajectories. Post-pandemic recovery shows a split between affluent versus low to moderate income sectors of the economy. Experian examined 2 geographic sectors in the US according to income levels based on the 2019 to 2023 census, and found that late payment and severe delinquency rates have increased significantly since 2021, with delinquencies in low moderate income locations increasing much more than high income areas. Now, this economic divide is deepening, and it's reshaping risk, access to capital, and overall business strategy across sectors. And there's a lot more insight in this week's report on the K-shaped recovery and income disparity. And that has to be it for this update. Remember to visit our Commercial Insights Hub for more information on small business. Subscribe to our YouTube channel to stay updated on all of our economic reports, and definitely connect with your Experian account team to start a conversation on how Experian data and insights can help your business. Last, remember to stay informed, stay ahead, and we'll catch you on the next one.